And welcome to Lecture 11 of Section 3, where we're going to dive into and deconstruct the thing that makes all directional traders profitable, trends. So I'm going to kick this off with a little quote from Ed Seykota, a very famous trend follower. You can see him here on the right playing his little banjo. Life itself is based on trends. Birds start south for the winter and keep on going. Companies track trends and alter their products accordingly. Tiny protozoa move in trends along chemical and luminescence gradients. So we see trends occur everywhere in nature and in financial markets, but academia is still perpetually debating whether they exist. And in our opinion, there's really no argument because we've seen legendary speculators exploit trends for huge profits. So here's a nice collage of some of the best trend following traders of all time, people that have exploited the trending nature of financial markets to make an absolute killing. This guy's Bill Dunn. He's a famous systematic trend follower, still in business today. Here's Paul Tudor Jones. Everyone knows who he is, global macro trader who's always looking for a trending market to hit. George Soros and his reflexivity theory was a huge proponent of hitting trends for profits. Here's Ed Seykota, a little bit of a younger version of him, who developed and was one of the fathers of the trend following style, and he made tons of money back in early 70s, 80s. And then you got William Eckhart here, who was one of the original trend followers that taught the famous turtle traders, who actually taught them trend following rules and made a ton of money doing that. So why do financial markets trend? We're going to dive into the drivers behind trends before we actually look into the price action component. So there's 5 things that we've identified as to why markets should trend. Slow reaction to fundamental shifts, cyclical expansion contraction, reflexivity, performance chasing / career risk, and herding and emotion. So let's dive into each of these 5 here and see why markets trend. So when it comes to slow reaction to fundamentals, we see this because institutions are slow to react to significant shifts in the underlying fundamentals. So investors struggle to give up previously held beliefs, and changes happen way faster than a lot of people expect. And a good example of this is Valeant Pharmaceuticals. We saw enormous growth out of that stock from 2008 to 2015 and through its aggressive acquisition strategy, and revenues increased from 1.2 billion to 10.4. And it was a hedge fund hotel. Everyone loved them. They loved the narrative. Everyone was piling into the stock. But then almost overnight, fundamentals changed drastically. So the controversy started with this Valeant's relationship with Philidor, a crooked pharmaceutical company. And once that was exposed, they had to cut ties with Philidor to save face with the public, and revenue started to plummet. And then they also came under fire for price gouging. And eventually, Valeant investors realized that the company was in huge trouble. And so this is what happened with the stock. Now we can see how the narrative was intact, and we had a nice, stable bull trend. And seemingly out of nowhere, the fundamentals drastically shifted, and we had a trend. But investors are slow to react to this information. You don't have a 1-week down move and then all of a sudden everyone in the world wants to liquidate. People have to examine the information that comes out, see if it's correct, see if they want to sell, and make many other decisions that take multiple weeks for large institutions and large funds to decide. And that's what creates this steady stream of selling. So not everyone's can get out at the exact same time extremely quickly. That's one of the reasons why we see trends. Second reason, cyclical expansion and contraction. So we talked about this before in a lot of our macro pieces that we write. Credit and debt move through the financial system and create leveraging and deleveraging cycles. And this is a pretty easy feedback loop to understand. So increased income leads to increased borrowing because since you're making more and you're worth more, the bank will give you more, which leads to increased spending, which makes more businesses rich, which makes more people have more income, and etc. And we go in this loop. This causes a trend, and the same thing happens in reverse during a deleveraging. So we constantly have this income net worth rising, so we're able to borrow more, and then we're able to spend more, asset prices rise, and our net worth and income go up. And then in the deleveraging, it's the opposite scenario where our income net worth goes down because asset prices are falling. We can't borrow as much because banks aren't lending to us because we're not making as much income and we're not worth as much, so therefore we can't spend as much. And then that has a downstream effect on other businesses, and asset prices continue to decrease, etc. So the feedback loop works both ways, and that's part of the reason why we see trending activity. So a good example of this and the positive upside is the housing boom. So we saw demand increase for housing, pushing prices higher, and then money flowed into the construction companies to meet the demand, and all of a sudden more houses are built and sold, and house buyers' net worth continue to rise because everyone's building and everyone's selling at a higher price because demand continues to creep up. And this creates a situation where people become of a higher net worth because the asset prices are rising. And at the same time, the lending standards decrease, and they're lending out more because banks are lending out more because everyone seems richer, and this leads to more and more house flipping and more speculation. And next thing you know, you end up with firefighters in the local stripper down the street in Vegas with 5 houses. And that nuttiness is caused by these feedback loops. So another concept that we see with economic expansion feedback loops is the 401k IRA concept. So during expansionary cycles, capital from these workers is continuously flowing into passive funds, and that's because there's an auto deduction from their paychecks directly into those funds. These funds are price insensitive, so as soon as the money hits, they're buying stock, they're buying bonds, and this creates a bullish trend because it's a perpetual inflow. When things turn around and the economy goes south, workers get laid off, and this auto investment spigot is completely shut down, and then we get the trend reversal. So the third thing we're going to touch on is the reflexivity concept, which is a little bit related to that contraction expansion cycle in the economy, but there's a slightly different touch to it. What we see here, and here's a little cycle showing how reflexivity works. We see improving fundamentals, which improve the price of the stock, which improve the perception of the company, which means that the company is able to borrow at better rates, and people start to flock to that company, support that company more, which improves the fundamentals, which makes the price go up. So we have a self-reinforcing feedback loop from that perspective. And our example here is banking. So if investors are bullish on banks, bank shares rise, and then higher share prices allow the banks to raise more capital, and they can earn higher profits by doing that. And then investors see higher profits and in turn buy more stock, and then higher share prices allow the banks to raise even more capital, and boom, you got the reflexive cycle. It's born right there and then. Now, the fourth thing we're going to talk about is performance chasing and career risk, and this is very much a psychological aspect of markets that's extremely relevant. A lot of people discount this and don't think about it, but it actually accounts for a lot of action these days and a lot of decision making from managers out there. So fund managers, to stay alive in the business, you got to stay invested in the hot sectors because everyone's competing with each other to get more money and raise more money. So this almost requires investing with the herd, especially if you're trying to keep your business afloat in the short term, because you need to be buying what's going up and selling what's going down in order to stay competitive. You can't try to raise money and be in a fund that is purchasing beaten down assets that are going to downtrend and go sideways for 5 years. You have to chase the hot money. And the reason why they chase the hot money is because that's what clients and investors always allocate to. They invest in what has recently performed well. Retail, on top of the professional side, also likes to buy what has performed well and sell what hasn't. So the mutual fund managers and not so the hedge funds that are trying to sell the institutions to allocate, but the mutual funds and the retail-facing funds that are trying to convince retail to allocate to them, they also want a performance chase. And the whole thing gets exacerbated by Wall Street and financial advisors because they know that retail likes to performance chase, and Wall Street knows that allocators like to performance chase, so they push the products that recently performed well, and the cycles continued, and we see the trending conditions play out. And so for a pension fund, if we study someone within one of those, we can see this concept of career risk come out that causes additional trending type of behavior. So compensation at a job that allocates is fixed. There's no performance incentive. So if you think about it, the manager deciding where he's going to allocate assets, he's going to just go to what has performed best in recent history. Because if he does poor, he can just simply point to the numbers and not be held accountable. It's far more risky to make the tough call, go against the grain, and invest with someone who has not been doing well in the last few years, because if it goes wrong, that pension allocator is fired. So from a career risk perspective, the pension allocator is going to want to just allocate to someone who's been performing well in the short term and not make that long haul decision over risk getting fired. Now, the last thing we're going to talk about is the hurting emotions of the market, and this plays into the price action patterns that we see. We talked about that in the price action as an emotional narrative lecture, but these are the classic emotions of any cycle or trend. So as something's uptrending, we have initial optimism, and then optimism turns into excitement, and then thrill, and then euphoria, and then the trend starts to turn. And so all these emotions, by the way, are increasing in strength as they go up. So excitement's a little bit more strong, and optimism, thrills a little bit stronger than excitement, euphoria is stronger than all of these, and that continues to push an increasing rate of momentum in price. And then as price starts to turn, we get anxiety, denial, fear, desperation, panic, and despondency. So again, these emotions feed off each other and get worse and worse and more extreme as the trend accelerates. And then the whole cycle repeats again. So people go through depression. Then as things start to rally again, we get hope, relief, optimism, and the whole cycle begins again. So the emotions of the market that humans naturally feel exacerbate price movements and create this trending activity. So now we're going to talk about the 4 stages of trends from a price actions perspective. So the first stage is the sustain stage, where we see a slow, steady rate of change. This is when the trend's beginning. Then the trend starts to accelerate in the strengthening stage. Then the weakening stage, when the trend decelerates or pulls back. And then finally the dissolving stage, where we transform to chop and consolidation and go into that second state of the market. Remember, we talked about consolidation and trending. If the trend dissolves, we go into a consolidation phase. So if we use these 4 categories, it help us simplify and clarify market price action even further. So I've outlined a few of the stages here on this chart of the euro. We can see stage 1 is the trend is just starting to begin. And then stage 2, now it's accelerating as everyone finds out and starts to realize that, hey, there's an extreme price change happening in the euro, and the trend starts to accelerate and go almost straight down. And then stage 3, we have this weakening and an initial pullback, and it tests the strength of the trend. And this trend had run its course, so we entered into stage 4, which was the dissolve. So this trend ended up kind of fizzling out. It held this latest support level and just turned into chop and has now formed a consolidation area. So in stage 1, in the sustain stage, this is what we're looking to identify. We want to hop on the trend before it starts to strengthen. So we're constantly on the watch for a possible sustain. And this happens when price exits an equilibrium or a consolidation area and starts showing signs of trending. And you should see a steady rate of change in price, and it should be consistent. It shouldn't chop around again, because that means it hasn't exited from equilibrium quite yet. So this little area right here would be an example of a sustain, where we see a bunch of chop, and then all of a sudden something looks a little bit different, and we see a movement that is steady and consistent to one side and continuing from then on. In stage 2, it's the strengthening phase, and hopefully we're on the train right now. We haven't missed it, and we're riding the trend. And when the trend is strengthening, price action continues to climb or fall if it's a downtrend at an accelerating rate. So although we like to be holding positions at this point, we don't want to necessarily buy into this, because it's considered to be a late entry and chasing, because parabolic moves are subject to pullbacks. So we want to be holding our positions during stage 2, but not necessarily entering. Now, if we were to look at stage 2 from this same chart in Apple, we had the consolidation, and then we had the sustain, and then you can see this trend starts to accelerate right about here, and it goes almost straight up vertical. So this is the strengthening stage. And the sustain stage acted a little bit longer than the sustain stage for most trends. And you can see the strengthening stage was actually preceded by a mini consolidation area. Now, stage 3 is the weakening stage. And this is the hardest part for the trader because it tests the beliefs of the trend, and you give back a significant amount of profits when the stage 3 occurs. So you have to constantly gauge whether or not the trend's over when stage 3 occurs, if it's just a pullback or if it's preparing for a second leg. And this is where fundamentals help. So if you have a strong fundamental case for a big move, you can have confidence that the weakness is only temporary and a next leg is coming. So the trend will either go back into stage 2 if it's going to go on a next leg and strengthen again, or enter stage 4 and dissolve. So a pullback or weakening of the trend So this decision where the trend's either going to go into stage 2 or stage 4 is an inflection point that's referred to as a test of faith. And if the trend passes this test, then the beliefs are stronger than ever before because the narrative has been confirmed and reinforced. So in the Apple scenario again, we have this weakening stage after this strengthening stage, and right here we don't know if the trend's over now. So this is testing the faith of the trend buyers in the bullish narrative, because we come down and test a point almost to the original breakout area. But then you can see this one passed the test and ripped up higher at an ever strengthening pace. So we had that test of faith that passed, and then this one happened to go back into stage 2 and strengthen again. In stage 4, this is where the move's over and the trend turns back into consolidation and chop. And we want to be out by this time and exit because there's no more directional bias and the narrative has dissolved and died. And if a market doesn't have directional bias and we're directional traders, that's not something that we want to be in. And they can lead to holding trades that are going sideways and frustrating you. So we want to identify for in a dissolve phase in stage 4 and exit as quick as possible. So in Apple, this dissolve phase started right up here, which was nice. We didn't have a deep pullback. We just had the trend start to fizzle out a little bit and chop sideways. And then we saw this latest break to new highs right there failed, and we continued that chop sideways. So it was pretty evident that the trend had begun to dissolve here and the bullish narrative was over. And sure enough, the trend reversed. So here is a trend schematic, a little picture to more easily visualize the different stages as they progress. So we start with that stage 1, that sustained stage, where the trend is emerging from that consolidation area, that equilibrium point. And then we move on to stage 2, that strengthening phase, where the narrative gets reinforced, whether that's a bull narrative or bear narrative, and people start to buy it or sell it at an increasing rate. And then we get to the stage 3, which is that pullback, a weakness, and that's either a temporary weakness, which passed the test of faith and goes on to new highs, in which case we're back in stage 2 again, or it turns out to be the end of the trend, and we go into stage 4, which is dissolve stage, where the trend turns back into chop, and we enter back into the consolidation or equilibrium. So let's go through a few more examples of this schematic here. So here's Pampa Energia, and you can see we have a sustain that comes out of a consolidation area, and then a strengthen, and this strengthen is sort of short, but we can see the weakness here with the test of faith back to the original area. And since it passed the test of faith, it increased at an ever increasing rate and ripped even harder than it did because it passed that test. And then this one hasn't played out yet, but we would keep getting this test of faith, or this would go on to dissolve into more chop. Here's silver futures, and we see the break up, the sustain, the strengthen. We have the weakness with the test of faith, and then an even more intense move to the upside, followed by weakness that did not get resolved to the upside and have a strong move, so it entered the dissolving phase, and then we had that reversal. And here's Wynn Resorts. So you see a few trends on here. We got a bullish trend where we started to have somewhat of a sustained move, and then it started to accelerate even further, and then it had a extreme weakness here, or a pullback that was never able to regain the prior highs, and so that turned into stage 4 dissolving, and eventually we reversed that trend, and the same process repeated to the downside. And here's a chart of GoPro. We had the initial sustained stage coming out of this congestion area, which started to accelerate. And then we had a little mini pullback weakness stage that tested all right and held this move and then ripped up at an ever-increasing strengthening pace. And then we had a major weakening phase right here. And the test of faith did not pass as the market tried to come up and resume the trend, instead halting at a level that was lower than previous highs. And so this ended up dissolving into chop again. And then you can see we broke the lows of the first tests and we entered into a downtrend. So here is our mental model of price action. And this is a combination of what we went over in the prior lecture and this one. And this is great because we can finally organize everything on the chart into different chunks. So price action can be broken up into two things. We got the consolidation zones and then the trend zones. And then within the trend zones, we have the 4 stages. So the sustain, which is the steady rate of change, the acceleration stage, which is strengthening trending, and then the weakened stage, which is a deceleration in trend, and then finally the dissolve stage where the trend's ending and then it turns back into consolidation. So use this mental model to your advantage to break down price on the chart and find out what stage of trending it is, or if it's in an equilibrium consolidation stage. So I'm going to go through what I see on this chart here in terms of that schematic. So obviously here it looks like a equilibrium stage or a consolidation stage. And then something changed right here where we had a sustained move in one direction that broke a prior support level. And then it drastically strengthened extremely quickly. And this one had a quick weakening bear rally, which ended up dissolving that downtrend. And so we went into more chop in this area, and then we broke up to the upside, cleared these prior highs, entered into another bullish trend. And here was our weakening phase, which did not pass the test of faith and make new highs. Instead, it turned into another dissolve, and we continued sideways. And then the process repeated itself. We had this sustained move down, and then all of a sudden we went fast down in a strengthening stage, had another bear rally, which weakened the bear trend, and this test of faith almost passed. It came in and actually broke these prior lows, but ended up being a false break, and we went the other way. And the process repeats. So you can see on the chart we enter through consolidation zones and the trending zones, and during the trends we go through each phase. We can see, again, after this bull trend here, it dissolved into stage 4, and then it looked like a bear trend was going to happen here, but we had a fake out and completely ripped to the upside, and it played out, and instead the 4-stage process played out up here. So we had a break higher, which ended up in a pullback that tested faith here and actually passed the test and broke prior highs, but then quickly ended up dissolving, and we're finding ourselves in another consolidation zone. So this is the way you should be looking and thinking about charts, and not everything's going to perfectly fit into the 4-stage and consolidation and trend schematic, but it's a good general rule that we can use to organize the charts. Here's another one in gold futures. So we have let's look at this consolidation area. I see a consolidation zone here with a trend that started to sustain coming from the bottom of the congestion area, which strengthened. We had a weakening phase here, which passed the test of faith and went up to new highs. And it continued this process. We had another weakening, new highs, another weakening, new highs. And so it went on that cycle where we went from stage 3 back to stage 2, if you remember on the schematic. We kept on having this occur in gold, which created a super trend. And finally, a blow off top led to another stage 3 weakening, which we had the test of faith, but then it didn't pass because it didn't break new highs, and it dissolved into stage 4, which was another consolidation area. And sure enough, that broke down on the consolidation area and then reversed the trend. So before we get wrapping up things here, we want to do a special note on bear trends, because they act a little bit differently than bullish trends, just because the world's levered long and the system is long only. So it's for these reasons that we got to watch on short trends about quick reversals. They tend to have more violent weakening periods, especially in things like equities. And that's because stocks and risky debt, they can go to zero, but macro instruments will never go to zero. So individual stocks, they can go bankrupt. Risky debt, they can go bankrupt. But these big macro instruments, like the S&P 500, gold, those are never going to zero. So as they go down, there's just more and more optionality embedded into the price because it can't go to zero. It's not like the S&P 500 is ever going to go bankrupt. So that we have to keep that in mind when we look at bear trends and be aware that the weakening phase, the stage 3 of those trends, can be extremely violent. And this is a good example of the 2008 crash in the Dow Jones. And we can see that, after this crash, we had this consolidation area, but then a sharp reversal back up, which reversed a large part of this move. And it didn't stay down for an extended amount of time. And you can see even on the way down on the more microstructure, we had falls that were quickly reversed up to almost 50% of the entire down move. And it's a little bit different on the upside. You can see on the upside, we have a lot more lower volatility and the pullbacks are shallower. But on the downside, we're going to have much more intense weakening periods of a bear trend, which do make them harder to trade. So it's just something to keep in mind as you go forward.